What's going on, guys? Good morning. Welcome in to another live stream here with the Everyday Growth Advisors. I hope that you have had a great rest of the weekend. We have a big week ahead of us, and I think everything that we've discussed for the past couple of weeks plays into this session right here. Now, let's just go through everything as we always do to guide you guys on your journey for this week. We'll be having another stream on Wednesday, and for those of you that do not know, we will be holding a 3-day investing and day trading bootcamp, which you will be able to sign up for absolutely free. I'm going to put the link to that in the chat right now. If you haven't yet signed up, make sure you go and sign up for that, because it's going to definitely help you to kind of refresh your memory on a few important fundamental skills that you have probably forgot. And we're also going to be heavily focusing on the psychological aspect of the market and how to deal with things like, for example, loss aversion or your imposter syndrome that's kicking your ass through your journey. Now, from the macro standpoint, we have had a couple of changes in the past couple of weeks, as we have been talking about the 10-year yield, which had previously fell down and now starting to move the opposite direction. And this has been putting a pretty big pressure on outflow of stocks, even though it has not been accurately represented on the S&P 500 price action. With that being said, we also spoke about the Fed interest rate change expectations. And as you can see here, previously we had spoken about how the chances of a cut in June or May, for this session here for March, it was pretty much at like an 80% or a 90% the last time, and now it's a 98% chance that we stay with the same rates this meeting, which is coming in 2 days from now. The May meeting also has now increased in the chances of the rate staying the same at 5.25 to 5.5, and the chances for a June meeting is now 55% for a potential rate cut, and a 41% chance for a staying the same rate at 5.25 to 5.5 once again. The market is undecided beyond this for the July meeting, which has a equal distribution between a further cut, a stay, or a cut for a second chance here. So by the July 31st meeting, we will, well, actually by the June meeting, we'll know more about the July meeting. But the market's pricing in the likelihood that we will stay with interest rates at where we are for at least the next 2 meetings, and then decide where we're going to go from there. So this week's meeting, will dictate a lot of that direction on where the optimism or pessimism lies based on where we are. As you can see, the current federal funds rate is 5.33%, which is between that 5.25 to 5.5%. And that is just likely where we're likely going to stay for the next 2 meetings, okay? So that's a quick little summary of where the Fed expectations are. Let's talk about price action on the SPX here. And you can see we're still in an uptrend. We've seen some nasty sells in the past, couple of sessions on between the Friday session and the Sunday session on the 8th of March, and then last week between the 14-15 session, as well as the week before that on the 4th March session. So we've seen equally some fear in the market with sell-offs here, and more importantly, we've seen a couple of pockets of the market holding up this price action. What are those pockets of the market that have been holding up? It is the financials, it is the energy sector, it is the consumer discretionary sector, which is this one right here, and also the materials sector. You can see that, as well as the industrial sector. These 4 sectors have been holding up the market, okay? Now, is it time for us to engage in some hedging or short-term short activity is the question. And my preferred method to play this is to go long on the VIX instead of going short on SPX. And the reason for this is because even though the SPX is not an overcrowded trade to the downside, I rather play on the reaction of what the expectations are on the SPX than play the direct expectations on the SPX, which means that I would be happy to take some long debit spreads on the VIX perhaps something like a 17-19 debit spread for a couple of months out, potentially into the uncertainty of the federal funds interest rate, which would be around the June or July meeting. So you would want to buy expiries that will range out to around that time. Now I'll post my exact entry in my contracts on the Discord and let the team know what I'm going to be taking. So if you do want access to that, you can obviously sign up for 14 days for free with us and kind of chime into that. But I will be taking a position in that this week to play some of that upside heading into FOMC on Wednesday. Now remember that this week is also a week with some heavy hitting news. So we have NVDA, GTC, where they're going to be releasing a new chip on Tuesday. We have the Fed decision for policy on Wednesday. We have the press conference on Wednesday. We have Micron earnings, Reddit IPO on Thursday. We have initial jobless claims on Thursday. We have services manufacturing PMI on Thursday. We have existing home sales on Thursday. We have Nike and FedEx earnings on Thursday. So there's a lot going on. Okay. Now, my expectation is that the market's likely to chop for the first 2 days of this week. But at the same time, I have accurately voiced out my concern over the weakening breadth of the NASDAQ here, which has now formed lower highs for 2 consecutive instances and tried to break into lower lows for 1 instance, which means that the market's likely changing its tune to move into a higher high pattern on tech, into a potential downward movement on the NASDAQ if we get a further rejection of this price action somewhere here or here or here, right? And so this rally that we're seeing right here, pre-market, is a very, very nice opportunity for us to take some potential short positions heading into this week, okay? And I mentioned this before. We've spoken about the NASDAQ breadth deproving on last week's live streams on Wednesday. And so I'm just reiterating my analysis, and I just want to once again point out that the NASDAQ is weaker here out of the two, as SPX hasn't really quite shown us that very, very strong weakness, but we're seeing that kind of lead into the market here. Now, IWM slightly still forming a base at around 202, but with the market potentially slated to roll over, this might not be a good bet to the upside just yet, right? As I've said many, many times, we need a clear break of structure with IWM in order to go long. Not that I am not in longs, just that I don't want you guys taking unnecessary risk here to the upside when the market's about to potentially go lower. And I would say that if IWM is able to hold 201 and then hold to 198 here, so in this region here, that would be a good region to potentially go long. But right now, as where we are, we don't want to take unnecessary risk for upside, just betting on the upside just for the sake of betting on the upside. So I would say tread carefully here. And also our favorite risk barometer, Bitcoin, has been seeing a little bit of uncertainty in the past couple of sessions, right? For 4 sessions now, we've been seeing, well, actually, sorry, 1, 2, 3, yeah, about 5 sessions now, Bitcoin has been seeing a little bit of a pullback. Not saying that obviously it's not going to go higher or whatever, but this is my favorite barometer for risk taking, and it's just been a bit weaker than the buybacks that we've been seeing, which is very well needed. Bitcoin has been rallying ruthlessly, so a pullback here, a snuff out of some longs that have been greedy up here is very important to cause some liquidity engineering, and that's just something that I will be looking at in the next couple of sessions. So 10-year yield moving out of this 4.359% zone is going to be a very important telltale sign as to how the market's expecting the interest rate changes, and that is going to potentially put a cap on SPX in the short term, and then put some downward pressure on NASDAQ because of the sensitivity towards tech stocks. Remember that when the interest rates go up, tech stocks have a bigger sensitivity to valuations getting devalued, and so that will be something that I will be looking at. Now, the dollar index, the reason why it has not been as sensitive as yields in the bond market is because gold has been rallying quite a fair bit, which makes the dollar weaker. Remember that gold is a dollar-denominated asset, and because of the fact that inflation has been coming down, people have been kind of plowing into this uncertainty with that asset, which has been causing a little bit of weakness in the dollar. Okay, and then the VIX, as I mentioned earlier, my pathway with that. I will be happy to take shorts on some specific sectors to kind of localize some of my factors. Now, what are one of the sectors? It's financials. Failure to break out of this 41-42 range is likely to keep this XLF ETF capped in this area and disallow it to move further higher. After all, in this daily chart here, you can see that XLF has been insanely strong because of interest rate expectations, right? Boeing bounce here, easy RR. Let's have a look. I'll see that in a second. Let me see. So let's drive into some of these charts and go through. Yeah, I like this chart, obviously, by Boeing. This is a nice one. I do agree this is an easy way to manage risk if you were to play the bounce off here. But unfortunately, with so much of bad news coming out of Boeing, I wouldn't want to touch the long trade. Even though it's good RR, I think I would wait to see if it can break below 176. And then potentially play it if it fake breaks out from the bottom here. So I don't want to touch this specifically, not until I have confirmation. Let's look at some other opportunities here. And by the way, if you have any tickers that you want me to go through, put them in the chat so that I know. If not, I would appreciate if you leave a like on this stream so it can reach more traders like yourself who are struggling or need help pre-market. I'd be happy to go through those. Of course, we're going to go through the regulars as usual. So let me talk about Square here. Last week, we had a really nice move after earnings. It rallied up into the supply zone here. And we saw a little bit of rejection at the $87 mark. It has come down since then to the $80 mark at the dual zone where we've seen past resistance now turn into potential support. And if NASDAQ deproves here, then this one's gonna find more downside to 74, 75, and if it does find even more weakness, it's likely to move down to 67, $68 for that gap fill that was created for earnings. If Square is able to hold $80 or $80, $79 around that area, then it might go for another stab at the 88, 89 or 90 level, which is up above it. So there's two ways this can be played. I wait for the pull back down to 74, see how it reacts here. If it breaks further down, then go for the 67 short. If it bounces off the 74 or bounces off the 79, then go for the $85 calls to play the upside here. So that's my plan with Square for this week. For Tesla, and yes, everyone's favorite. Now this one has had an insane amount of bad news, or rather downgrades in the past 1 week. And it's really, kind of dazzling to me how the news grips the narrative and then causes a lot of fear and panic. And you can see that's exactly what has happened to Tesla here, right? And for the past 3 live streams, I've been talking about the fact that this stock still has very, very attractive risk to reward for the upside, especially for a long-term stock owner, okay? In fact, last week when it came down to 162, that 150 level, which we have been talking about, 140, well, this level here, 138 all the way to 145, and then the potential bounce at 155 was my opportunistic potential entry for leaps on Tesla. I was going to go take the risk to take on some leaps at that area, but it since then has not given me a potential entry, and I don't feel comfortable playing this long here, not until and unless we have confirmation that this indeed was a potential bottom. See, the thing is that a lot of people get trigger happy with the gap up this morning and then want to play the upside, which is not a bad thing. I just think that you don't have confirmation that this is the bounce. And so you need Tesla to come down to engage with this level at where it made this low at 160.75 or so. And if you drill into the 1 hour chart, you'll see what I mean here, right? So you really want this to come back down and retest this level for a bounce. It doesn't matter where it bounces, but it needs to bounce above. It needs to bounce above where it made lows here, which is 160.5, okay? I want it at 150, haha. Yes, I know. I am also waiting for that to happen, obviously, to buy some leaps, right? But once again, you don't have confirmation that this is the bottom. So what you want is a pullback bounce interaction with the buyers stepping in higher than where they were to show that demand is indeed higher at any one of these levels. And then on a 15-minute two-wave confirmation, which is one of our EGA trademarks, right? You can see that kind of play out. So what are we looking for here? You have this sideways channel that was created, and now it's moved up above it. What you want is a wave up and then a wave up further. So right now you have this wave up already, right? It's come up here. You want to pull back and then retest at this previous level 164, 165. And then you want to bounce higher and then another retrace to potentially show us that this is now ready to take off. And so you want a absolute confirmation here, not just a punt. That's how you want to really take your objective here with Tesla, okay? And so till you really get that, you're not really going to be able to take a long position here because of the amount of people going short. Now, I did post a couple of things on our Telegram and EGA Instagram broadcast. On this dip that you have been seeing, Vanguard, BlackRock, a bunch of other big institutions have been averaging down their positions because they have very high cost averages. In fact, majority of their cost averages are between the 180 mark all the way up into the 220 mark, which is up here. So there is incentive for them to buy the dip and push Tesla to the upside. But obviously, retail traders are going to be focusing on the idea that Tesla is going to run further down, and derivative traders are going to be focusing on sending Tesla further down to create some of that liquidity. So you want to be avoidant of any kind of manipulation here in the short term, which is what is going to happen. Retail traders are going to continue to exit the market while institutions are going to be forced to buy into their positions because of said retail trader activity. So because of that conflicting price action that's going to go on, you're likely to see Tesla move in a sideways movement for a little while, and that's going to give you some opportunities, okay? So let's review this in a week from now to see where it goes so that I can further guide and further understand where this price action is going. Right now, I don't have incentive to take the upside, and I don't have incentive to take the downside. So therefore, I don't feel comfortable trading this, getting a long-term position in this. In terms of trading, we'll talk about it more as the price action develops, okay? Next up is Starbucks. This is another one that I'm looking at for this week. Have a look at this. It has moved down significantly down into the $90 level, 89.90. And if it breaks it below 90, then this opens up a potential downward shift all the way down into the 82, 83 mark. So there is some significant downside here. And there has been a lot of bad news surrounding Starbucks as well. So I would be okay with trading this to the downside with the down movement on SPX if it gives me that move. If it bounces here, then I'm unlikely to play this. So how would you go about playing this? Well, the more safer way is to wait for the break, right? Wait for the break so that you don't get yourself into a situation where you get faked out, right? Wait for the break and the retest. And if you get a retest of the $90 level and it rejects it, then you can take the downside into the 85 puts or the 86 puts, somewhere around there, for at least 1 to 2 months out. Okay, make sure you buy enough time because this moves very slowly and it has very slow movements in terms of dollar move. Look at how big this move looks like, but it's only realistically a $4 move. So even this from here, $90 if it rejects, expect it going to take some time to move down into the 83, 84. And so you have to be aware of that, okay? Next up is FCX. This is in the materials sector. We saw a lot of options flow on this and a lot of volume come in the past 1 to 2 weeks. I would love a pullback on this one, a failure to break out, and then a bounce on the 42 level or 43 level for some entries to the further extension. Now you can see this is also a breakout on the daily chart of a downward falling wedge kind of pattern. And so the price action moving out here would suggest that it's going to make a higher movement with bigger impulse coming out of this 1, 2, 3, 4, 5 wave movement. Okay, so a movement back down to 42, 43 would set up a nice liquidity engineering into the 23.6 extension at 45. And that would be my first target if it's able to break above 44, 45. and then consecutively break above 47, which would lead it to ultimately 49 and 52 if it goes for a 61.8 extension. So this is one of those high volume stocks that I'm looking at, apart from Starbucks, which also saw pretty decent volume last week. Okay, now NVDA, this one has been moving quite a fair bit for the past couple of weeks. It's set up a range now, and it's pretty much in a pennant style movement, if you were to look at it. And this pennant style movement, ignoring that big fake out there, is setting up for a potential break either above 916 or below 862. And I wouldn't touch NVIDIA until and unless it starts to validate any of these levels. It needs to either break above this level and start forming a base here for the upside, or it needs to start breaking below and rejecting this base for a downside. So very, very simple price action analysis here with NVIDIA. You don't need to reinvent the wheel, okay? Just keep it simple. Now, I have seen pretty decent price action on NVIDIA this morning in terms of open interest, so let me show that to you. There's still a big change in the 885 puts that was bid towards the mid price. And so the 885 puts for March 22nd expiry, which is this week expiry, was one of the most changed open interest from last week. That means Friday to Monday. Okay. And then second, beyond that, was the sale of $900 calls. In other words, market makers are incentivized by next week. By the way, those were for 329. Oh yeah, is next week a stock market holiday on the 29th? Because these options go for 328, so it must be. But essentially, the 900 calls have been sold for next week at 328. And let me just show you this so that you understand what I'm talking about here. So here you go. So look at this real quick. So for the 885 put strikes, you can see this is the biggest interest change. The next up was 6,000 plus 6,000 open interest for the 900 calls for 328. But you got to understand something. These were sold calls because they were bid side. Okay, that's how you analyze this data. Okay, so because they were sold side, so someone is trying to keep price action below 900 and above 885. Okay, somewhere between there. So it's likely to ding dong. Okay, it's ding donging between those two prices, and that's kind of where NVIDIA has been trapped. Yes, I think it's Easter holiday next Friday. If someone can confirm, I believe it will be Easter holiday next Friday. That's the reason why the expiry is 8/28, as you can see here, and not 8/29. And that will also be the start of our boot camp on 8/29. So if you haven't signed up for that, I've put the link in the description, and I am now going to pin it to the chat so you guys can have access to it. Okay. Make sure you sign up for the boot camp. It's going to be really fun. I'm going to get a lot of you involved, and you're going to have a hands-on session of learning with me. So I hope that I'll see you during the boot camp, because it's going to be great. Okay. Okay, next. And I'm going to try and end the stream quickly, but I do have a lot of opportunities here technically. I'm just going to go through a couple more of them. Roku, this is another one that a lot of you have been looking at. We've been talking about for multiple weeks. It has not made a break on either side. Okay, so do not speculate until and unless you see the break on either side. Okay, and the break on either side has to be either above $67 or below $61. Okay, and so far it's been trapping between both of these levels, so do not play this until and unless you see that. Okay, very, very important. And Carvana, this one I'm not going to touch just yet. D-Dog pulled back nicely to the 120 level. I'll be watching for a potential bounce on this one into the next two sessions. But as I mentioned, just to summarize today's stream very quickly so that you guys can head off for your trading session. My conviction still stays that NASDAQ is getting weaker compared to SPX, okay? And however, the next two trading sessions until Wednesday after FOMC, we are likely to see sideways action, okay? So I would not bet on upside or downside on SPX, but rather go long on VIX. Okay, go long on VIX through a debit spread. You could buy the 17, sell the 19, or buy the 19, sell the 21, depending on how ballsy you are. But I believe that today, even if you look at the option chain, these should give you easily a 1:3 risk to reward ratio, and that also with fixed risk. For those of you that don't know what I'm talking about, you can ignore what I'm saying and just go and buy some 17 calls or buy some 19 calls. But I like to use the expectation of where the VIX is heading to fund some of my calls. Therefore, I'm selling the $19 calls to fund my buying of the $17 calls, making my buying of $17 calls cheaper. Okay, and so that's what I'm planning to do. And if SPX rejects this 5175 or even goes higher to 518 and rejects there, I will likely also initiate a short position on SPX depending on my risk to reward object over here. Okay. Last week I took some trades that played out quite nicely, and then some trades that didn't play out so nicely. Tesla was one of them that did not play out so nicely. So that's where I'm at for the week. It was, I think, still a green week, and that's all I have for you guys for today's live stream. I hope it was helpful. Let's see. Okay, must be the 29 UVXY shares. What is your price target? UVXY. Okay, so UVXY is the pro shares. Let me see. This one's leveraged. So UVXY, remember this is it's leveraged. Okay, I believe it's 1.5 times leveraged. And you can see there has been some increase in volume here. Now, listen, if you're going to go shares with UVXY, I highly do not recommend it. And for one very simple reason, and it's a technical reason, okay? Because UVXY is a leveraged ETF. So therefore, the leverage causes the ETF to return you non-geometrical returns. In other words, the leverage itself eats into the expense of the ETF, and it doesn't allow you to hold this with a mathematical advantage. Okay, so instead of doing that, just go bet VIX instead of doing UVXY. Okay, but if you're looking for UVXY targets, then you know the immediate target would be $8 or $8.90. So that would mean some $9 calls if you want to go and bet on calls. Okay, and right above that, you'll be looking at some $10 calls. So. Do I like that very much? No, I don't like that very much. So I wouldn't buy shares. If you want to bet on this, bet the options. Do not play the shares on UVXY because they will skew your return over a longer period of time. If you're planning to hold it for 1 week, then sure. But if you're planning to hold it for more than 1 week, I don't recommend it. That's my take on this. And just being in the market for that long, I can just tell you that holding shares on UVXY doesn't play out well because this is an ETF designed to go down, okay? Yeah, if you're planning to hold it for less than a few days, then sure. But remember, there's likely to be, very unlikely to be movement on that then, right? So until unless you're trying to time it perfectly, which I don't recommend as always, you'd be better off spending less exposure to play the options. Remember that, okay? So think about it. You'd be spending how much on equity? If you buy 1,000 shares, you're paying $7,000, but you could get the same effect by buying 10 contracts at a fraction of the price. Okay, so it just doesn't make sense. Okay, and that's all I have to say about that. I wish you guys all the best on your trading session. Once again, if you're on your way out, hit the like button if you can, and we'll see you back on Wednesday for another session. Take care till then, peace out, and I hope that you guys enjoyed the stream. Bye bye.